When people talk about successful investing, they usually focus on one thing: returns. People say things like, my portfolio gained 12% this year, or my fund returned 18%. But here's the question every smart investor should ask: compared to what? Because earning 12% isn't necessarily impressive if the overall market gained 15%. Today we're going to discuss one of the most important concepts in investing: alpha. And by the end of this video, you're going to understand what alpha is and why professional investors obsessed over it, and how it's calculated, and why it's one of the best ways to determine whether an investment manager is actually creating value or simply riding the market. Hey, it's Frank Nagy, and welcome to my channel where we help investors understand various market environments, risk management, and alternative investment strategies. If you're new here, subscribe to my channel and hit that like button. Alpha measures how much an investment outperformed or underperformed its expected return after accounting for market risk. In simple terms, alpha tells you whether a manager actually added value. If your investment goes up simply because the entire market went up, that's not necessarily skill. But if your investment outperforms better than what market conditions would normally predict, that's alpha. Professional investors often return to alpha as excessive return. It's the return that cannot be explained simply by market movement. Let's look at an example. Suppose the S&P 500 returns 10% this year. Fund A returns 12%, and at first glance, that sounds pretty good. What if Fund A took much more of a risk than the market? Maybe the extra 2% wasn't actually impressive. Now consider Fund B. It also returns 12%, but it took substantially less risk while generating that return. Fund B may actually have generated much higher alpha. That's because alpha doesn't just measure performance, it measures risk-adjusted performance. That's a huge difference. Professional investors care far more about consistent alpha than simply chasing high returns. This is one of many strategies DataBridge Capital Management applies when managing non-directional investment portfolios with a focus on risk management, market analysis. The firm's objective is to develop structured investment approaches grounded in portfolio construction, risk control, and long-term capital growth. Alpha is always measured against a benchmark. For the US large cap stocks, the benchmark is often the S&P 500. For technology funds, typically the NASDAQ 100. And bond funds have their own benchmarks. Without a benchmark, alpha doesn't exist. Alpha can be positive, zero, or negative. A positive alpha means the investment manager generated returns above the expectations. A zero alpha means the performance matched expectations, and a negative alpha, it seems he underperformed the expectation. Over long periods, even generating 1 or 2% of annual alpha can be extraordinarily valuable. That's because investment returns compound. An additional 2% per year over decades can create dramatically larger portfolios. One great year does not necessarily prove skill. Professional investors look for alpha that is consistent, repeatable, risk-controlled, and sustainable. Generating alpha year after year is one of the biggest challenges any professional manager undertakes. The market constantly evolves. Competition increases. Information spreads almost instantly. Maintaining an edge requires discipline, research, and effective risk management. This is where alternative investment strategies often come into the conversation. Many alternative managers aren't trying to simply outperform during strong bull markets. Instead, their goal is to produce positive returns regardless of the market direction. Market neutral strategies and option income strategies, these are all approaches often seek alpha that is less dependent on whether the overall market rises or falls. That's what DataBridge Capital Management is all about. Of course, no strategy guaranteeing positive alpha, but investors often allocate part of their portfolio to alternative investments because they hope to diversify those sources and returns beyond traditional stock market exposure. When evaluating an investment, don't just ask, what was the return? ask how much risk was taken and what benchmark is being used and how consistent are those results. Alpha is more than just another Wall Street buzzword. It's one of the clearest ways to evaluate whether an investment manager is truly adding value. Or understanding alpha helps you look beyond impressive looking returns and focus on what really matters: risk adjustment returns. To learn more about ThetaBridge Capital Management and our investment strategies, risk management approach, and portfolio construction process, click on the links below in the description box.